There may be a hidden financial risk within your current homeowner's insurance policy that you may not be aware of. This is something that may have snuck up on you without you knowing, hidden from view, that may put you at risk of hundreds of thousands of dollars of potential losses if you don't take action immediately. Let's talk about what that might be. If you have a home or any structure for that matter, real estate, commercial property, that you've owned for more than 3 or 4 years, you likely have a property insurance policy for that property. It could be a homeowner's policy, could be a condo policy, it may even be a commercial structure policy. When that policy was written, it was written with a dollar amount associated with the property value or with the property reconstructed value. And over the last 2 or 3 years, as we've seen, property values have gone up dramatically, and even notwithstanding property values, construction costs have gone through the roof, where it may be used to cost $180 to $200 per square foot to build an average single family home. In some areas it might be $350 or $400 a square foot to build the same exact home today due to rising lumber costs, inflation, even availability of materials such as roofing and even finished materials like paint, windows, doors, appliances. So how does that affect you? What is your financial risk? Well, your homeowner's policy likely is based on a certain dollar amount. Let's say if you buy a house for $350,000, the insurance underwriting at the time of your policy might have figured, well, the lot is worth $100,000, so the construction cost of the building is the remaining $250,000. And they'll also approach that amount by looking at building cost. If it's a let's say 1,800 square foot house at maybe 200 or 210 per square foot, that'll be just over $200,000 plus some costs for maybe detached structures or other screen porches on the property, and they come up with a value, and that's how much they give you for insurance, and you pay your premium based on that. What happens though if the market value goes up on that house to $450,000 or $500,000? Look, many houses that were worth $350,000 in 2018 or 19 are now worth over $500,000. Now, if it was just the market value of the house, that wouldn't affect your insurance to replace it. They don't buy you the house next door. They fix your existing house. But one of the factors that has gone into increasing house values is construction cost. As a licensed insurance agent and also a licensed general contractor, we see this from both sides. As a contractor, we see construction costs through the roof, where that house that may be insured for $220,000, $230,000 might cost $400,000 to rebuild in today's market. And if you have a policy that will only give you $220,000 or $230,000, even if there were some small annual bump ups, 5% a year, you're not going to have enough money to replace a house that's completely destroyed. Hurricane, tornado, fire, whatever the cause is. So what you want to do is get with your agent and make sure that the coverage that you have matches what it would take to rebuild your house. And don't let your agent use some standard estimating software, because a lot of the software has not been keeping up with the construction costs. What we would recommend doing is contacting a local builder and giving them specs on a house like yours and asking them what it would cost to build it. Or maybe looking at a new home that's similar to yours in your area and looking at the price, deducting the land value, and seeing what that number is. It might be difficult to get your agent to write a policy for a higher value than what their software estimates. If that's the case, you can ask them, well, what should I do about covering my risk for a house that's going to cost me $400,000 to build when you can only give me $290 in policy coverage? We recommend you asking them that in writing. so you get an answer. One of the things you don't want to do is be put in a position 2-3 years down the road where, God forbid, there's a loss on your property and it's not covered and your agent can't do anything about it because they say, well, that's the coverage you selected. This is an important potential gap in coverage because if you have a loss, you either have to build a smaller house, buy a smaller house, or not have a substantial improvement from an empty lot with ashes on it if your house burned. In addition, most mortgage loans are going to have a provision that require you to build the house to substantially similar specs as your previous house. Again, we're not attorneys, we're not giving you legal advice, but check your mortgage. So let's say you have a house that you bought for $280. I'm sorry. Let's say you have a house you bought for $350. You have coverage for $250. The house is now appraised for $500. It'll cost you maybe $400 to rebuild it. House burns to the ground. God forbid. Nobody gets hurt. Your insurance company pays you $250. You have a mortgage maybe of $300. Your mortgage company, they're going to take the money. They're not going to let you get the insurance claim paid to you and then you walk away with the cash. They're going to take the money and say, you can have this money if you rebuild your house. If you don't rebuild your house, then technically you're in default on your mortgage because we don't have a house now that's securing our loan. So they take your $250, they foreclose, they sell the property, the land for $100. Now they're even, but you're out a house. So this is a worst case scenario. Make sure you're considering all of this with the coverages that you have and work with your agent. And look, your agent's there to help you. They just may be restricted a little bit by their underwriting for their insurance companies. So you want to make sure that you get good advice from your agent, maybe other agents. Look, we're not trying to take business away from your agent. If you have a good agent, work with them. If not, work with another agent. But the most important thing is that you are protected. That's the purpose of insurance. That your financial well-being is covered. That's why you buy a policy. It should be that your agent and the insurance company wants to have higher coverage because your premium is going to go up. If you have coverage for $350 and you now have a new policy for $520, you're going to pay a higher annual premium for your policy. But it's worth it to cover your equity. If you now have equity in the house, or you have a residence that you depend upon to live in, you don't want to be in a position where you have an unprotected asset. It may be that you have to get some supplemental policies, maybe an umbrella policy or some supplemental insurance on your residence. Work with your agent on what that might be. The most important thing is to get a very good, accurate estimate on what it would cost to rebuild your structure in the present day. And this is probably going to go up again in the next few years. Construction costs are not going down. There's many factors that are going into construction costs. One is the labor of the construction. Commercial construction companies are having a difficult time getting labor and they have to pay higher fees and labor rates. Another is materials. Another is the lumber, and you've seen the lumber prices. It's all over the news. How much per board feet. It went up over $1,700 per thousand board feet at one point. And back in 2018, it was $400. So that's a 4 times increase. That could add $30,000 or $40,000 to the reconstruction price of a house, notwithstanding the other materials, because there's more materials in a house besides lumber. There's all your sheetrock, drywall, interior finishings, moldings, doors, casements, roofing, trusses. All of these things add to the cost. Plus, if you add 20 or 30% increase in labor costs, next thing you know, building the same house today, 2,000 square foot house, versus 2018 or 2017 might be 150, 200,000 more in construction costs for the same house. Plus, you're going to have to get some permits. And those permits might be different today than they were 10 years ago when your house was built. There might be different requirements. You got to make sure your policy covers all of that. So you don't want to have a $100,000 or $200,000 liability hiding within your insurance that you don't know about. If you know about it and want to self-insure that, that's fine. But just make sure that you understand what your coverage is versus what it costs. Getting back to how you can determine that today's market value construction cost. It might be difficult to get an actual general contractor to give you a full estimate on constructing a house when they know that you're really not serious about building. Because for them to do an estimate, it's going to take them 3-4 hours of work, probably more, to do that. They're willing to do it for a prospective customer where they might earn, tens of thousands of dollars on a construction job. But if they know you're just doing it for insurance purposes or you don't seem that serious, they might not drop everything to work on your bid. So how could you go about doing it? Maybe you want to pay a contractor a few $100s to get an accurate written bid estimate. You might not think you should have to pay that fee, but if you need that to get your agent or your insurer to write your policy at a higher amount, maybe that's the way to go. Maybe it's enough to use some construction industry estimating software that you can find online to create an estimation. Maybe if you get your agent to use their insurance industry estimating software that they're coming up with a lower value, to give you an itemized printout of what those numbers are, where you can now point out, no, lumber is not $800 per 1,000 board feet, it's $1,700. Labor is not $14 an hour, it's $30 an hour. And you can look and line item all these things to show where their numbers are off. Because you can expect some pushback from your agent or your insurer about writing a policy that they think is a lot higher than the value of your house. They don't want you to have a windfall if you have an insurance claim. It's not in their best interest to insure a house for $1 million if it's only worth $200,000, because that gives the homeowner a big incentive to maybe let something go wrong that shouldn't go wrong. Not saying you would do that, but that's why insurance companies don't overinsure things, because it's too much temptation for somebody to have a windfall. They want you to be whole and even where you started. They don't want you to jump ahead by having an overinflated policy. So they're going to be cautious about valuations. So you might have to document why the valuation is as high as it is. You might have to document why the replacement costs, construction costs, are at the level that they are. Maybe the insurer is not aware of it. Maybe their software hasn't caught up with it. And you documenting it might help you do that. The moral of the story is, don't let $100,000 or $200,000 liability risk lurk in your insurance policy that you think you're protected for, because that might put the well-being of your finances and your family's residence at risk. And that's probably not the reason you bought insurance. You bought insurance to make sure you're made whole if God forbid something goes wrong, not to have a big gap staring you in the face that you either have to build a smaller house, move somewhere else, or lose out on the equity because the bank takes back your property.